Hi, welcome to another podcast. What we're going to be looking at today is errors and how they affect profit and working capital stroke net current assets. Students often find this a tricky operation. It's not really that hard, provided you think about it in terms of journal entries and follow a few very, very simple rules. So the first thing I want to show you is something about the income statement. So if we look on here, we've got a very, very simple income statement. What we've got the revenue, less sales returns, and then we've got the cost of sales calculations that you're all familiar with. So your opening inventory, purchases like carriage inwards, less purchases returns, less the closing inventory, add any discount received as an additional income onto the gross profit. And then we've got a few expenses in here, and we do the adjusted gross profit, less the expenses, gives us our profit for the year. What a lot of people don't realise, this originally came from, it used to be shown many, many years ago as a simple T account. So if we look here, I've got a simple T account put over here on the right-hand side. And we'll start off by putting in the revenue. Well, the revenue here was 20,000, so let's transfer that to 200,000. So we'll transfer that across. And as we know, following dead click, revenue is a credit entry. Sales returns, again, because we are gaining back the asset that we sold, that's classed as being a debit entry. It's the opposite of a sale. Open inventory, well, that's an asset. Pretty straightforward. Everybody knows that inventory is an asset. So that goes in. Purchases are an expense. So put the purchase on the debit side. What we can see down here, I've got the credit and debit columns slowly being added up. Carriage inwards, that costs the business some money. You credit bank, you debit carriage inwards. Purchase returns, well, they're the opposite of purchases, and also we're losing some goods. So for both reasons, it goes on the credit side. Put the 10,000 in there. Now here's a strange one: closing inventory. Closing inventory. I actually did it before in a couple of podcasts and mentioned it. But closing inventory is a strange one because it's a debit entry in the statement of financial position because it's an asset at the end of the year. It's actually a credit entry in the income statement. It's a credit entry because we're trying to work out how much our sales cost us. So although the closing inventory would have been part of that year's purchases, it's actually going to be net part of next year's cost of sales. So we're taking that away from purchases. So it's actually a credit entry in the income statement. So I'll put in the 10,000. Okay. And discounts received, well, that's a form of income. It's 10,000 again. And then we've got three expenses. We've got wages, 40,000. All expenses are debit entries. Discount allowed by the firm is a debit entry because it's an expense to the firm. And carriage outwards. Okay, that's also an expense to the firm. And what we can see here now is we've got a credit side that's bigger than the debit side, and it's bigger by 60,000. If we look down here at the profit figure, that's also 60,000. So if we put the profit figure in, okay, miraculously, our T accounts will, provided I press an add sign in here, be the same. So profit really is where the credit entries that go into our income statement are bigger than the debit entries. Why is that important? Why is it useful? Well, it's useful because what that's going to allow us to do is think about journal entries, how they affect profit, because what we can think about is if we credit something that goes into the income statement, we're going to increase the profit. And if we debit something because of an error in the income statement, we're going to reduce the amount of profit. So I've got three examples here, all pretty straightforward. Okay, let's work through them the way that I would do it. So as always with any kind of error, I'd always think about the journal entries and jot them down as part of my workings. And for the first one, we've got a purchase of a motor vehicle for $5,000. It was incorrectly recorded in purchases. So the first thing is it should have been in my motor vehicles asset account. So I should debit motor vehicles. I need to take it out of purchases. So I need to credit my purchases. The debit entry, asset. Statement of financial position, no impact whatsoever on the profit that this business has made. However, the purchases have been reduced. Now, if we're reducing our purchases, we are going to increase our profit. Or, looking at another way, and you can see exam questions done both ways, our current profit, which in this case is 60,000, will have been understated by $4,000. So, got my little table. You normally see a little table like this in an exam question. And I'm going to put the 4,000 in the either profit understated or profit should be increased column. Next one, purchase return of 4,000 was incorrectly credited to sales returns. Okay, so first thing we shouldn't have done, it shouldn't have ever been credited in sales returns. So we need to cancel out that entry by putting a debit entry into the sales returns account. And purchase returns, well, they're normally a credit entry because we're losing stock items, and therefore I should have credited purchase returns. Now, if we look here, I'm debiting something in the income statement and I'm crediting something in the income statement. I'm doing it by the same amount. So actually, for the second one, there's going to be no overall impact on profit because the entry in the sales returns, well, that's going to decrease my profit by $4,000. But because I've credited purchase returns, that's going to increase it by $4,000. So that's going to have no effect overall. And I've got a final entry here. Final entry is closing inventory was over recorded by 2,000. Well, this one's going to take a little bit of thinking about. But the first thing we need to do is we need to reduce our closing inventory in the income statement. And if you remember what I said before, it's actually a credit entry, the closing inventory in the income statement. So therefore we need to debit closing inventory in the income statement. And what we also need to do is we need to credit the closing inventory in the statement of financial position to reduce it. Now, some people find that a little bit difficult to think through that way. And there's another way of looking at it. Okay, if you look up here at the question that we were doing before, I've put in all the figures for our opening and closing inventories, etc., with the sums down the side. So we started off with the opening inventory, we added on the purchases, we added on the carriage inwards, we subtracted the purchase returns, and we subtracted the closing inventory to get us a cost of sales of 95,000. Well, there's been a change now because we over-recorded our closing inventory. What we need to do is we only need to take $9,000 off when we calculate our cost of sales. So that gives us a corrected cost of sales of 96,000. If we increase our cost of sales, we have got to have decreased our profit. So either way, our profit will have been overstated or our profit needs to be decreased because of the error. And again, you will see it written both ways in an exam question. Okay, and now if we actually look at our little table over here, we've got overall we should have increased profit by 4,000, or it was understated by 4,000, and we should have decreased the profit by 1,000 for the second entry. So the overall impact on our profit will be an overall increase of profit of $3,000. With these questions, be really careful and make sure you understand the terminology used at the top or in the question. Is it to do with understated profits, overstated profits, or does it say that the error would either increase or decrease the profits and by how much? Right. What I suggest, I'm going to split this video into two, and what I suggest you do at this point is you actually go and have a go at the question, which is question 1 of 2 over the page, and have a go at working out the effects on the profits of the 3 errors that I've identified in here. And what you will find is that wasn't the answer. Okay, good luck, and I'll be giving you a second video on a similar topic for you to do as well, probably as part of the same homework.